Bisk Education.
What situation would auditors define as a red flag that would cause them to suspect fraud?
Dennis Dycus is a CPA, CFE, and CGFM. He is the Director of the Division of Municipal Audit for the state of Tennessee. The division is responsible for audits of all municipalities, utility districts, school activity and cafeteria funds, housing authorities, certain not-for-profit organizations, and other quasi-governmental entities. In addition, each year the division staff conducts numerous audits for fraud, waste, and abuse. Dennis and Jack join us for the third segment in a 5-part series on the prevention and detection of fraud. In our last segment, Dennis Dycus joins Jack Norman for the third session in a 5-part series on the prevention and detection of fraud. Dennis points out the red flags that an auditor should consider if she or he is suspicious of fraudulent activity. Dennis also explains some of the pressures that auditors face due to recent publicized fraudulent activities. Let's join Dennis and Jack as they discuss these issues.
When I was being trained as an auditor initially, going back to my college days and early career, we didn't really plan or look for fraud as a function of the audit. It was to provide an assurance on the financial statements. Has that changed?
Yes and no.
Yes and no.
Yes and no. There's no real pat answers here. We have always been responsible, to some extent, for the detection of anything that would have a, quote, direct and material effect on the financial statements.
Right.
So even then, and I know that was a long time ago, but even then you were responsible, although we didn't acknowledge these responsibilities.
We sort of said if you stumble across it,
if you
then
stumble on it,
right.
And even then when you stumble across it, unless you knew what it was, oftentimes you'd get up, dust yourself off, step over it and go on, because you weren't trained to audit for fraud. You weren't trained to recognize fraud. So oftentimes we look fraud right in its face, right in the eyes, but we didn't know what we were looking at, and as a result, we didn't detect it. However, as a result of some tremendous frauds that were discovered as a result of audit failures that came to the limelight, the citizens, the taxpayers, the courts, and the SEC brought a tremendous amount of pressure on the accounting profession, the audit profession, that said you are responsible for the detection of at least any fraud that had a direct and material effect on the financial statements.
So we have to plan to find fraud?
You have to plan, you have to document. The standards now require that you document what you did to determine if there was an increased risk of fraud. So to that degree, every audit must address the possibility of fraud. So based on internal controls, based on the control environment that we previously talked about and many other things, is there a possibility that fraud could exist? If the answer is yes, then you have to document in your working papers how you expanded the scope of your audit to address those possibilities.
Okay. You mentioned materiality.
Yes.
Is the government environment of materiality the same as the private sector definition of materiality?
No. SAS 82 on the detection of fraud in financial statement audit for the first time acknowledged that materiality or tolerable error in an audit in the public sector versus materiality in the private sector may be defined differently. Now, it did not define it differently. It said it may be because in the public sector you're auditing in a fishbowl, because unlike the private sector, the financial statements, unless you're an SEC registered company, aren't widely made available. It's between you and the client.
Right.
In the public sector, those financial statements are, quote, public information. Taxpayers are going to be looking at them, bond rating agency, bond holders, lots of investors, lots of other people and entities are going to be looking at those financial statements. And that's my dollar that you're auditing. The taxpayer, that's my dollar, and I'm concerned about that. So I'm concerned at any level of fraud in the government. I'm the taxpayer. I'm concerned at any level. So what would be acceptable for a tolerable error, in other words, an amount of fraud or error in the financial statements that would not cause them to be materially misstated, I may not accept that as a taxpayer. So you need to consider, and how much of a lower of materiality? I don't know. I can't tell you.
That's where I was headed. You put me on edge by saying it's not the same. It's a lower level.
It's a matter.
Now I was hoping for you to help me find where that lower level is.
Well, see, the literature does not give you a formula to compute materiality, because if it gave you a formula, the fraudster would have access to that same formula.
Right.
So I know I could steal up to so much and you not be concerned with it. So it's just a matter of professional judgment.
If you're an auditor,
Yes.
you have professional judgment, how do you assess where that level should be? What things go into ratcheting that? Programs, dollars, visibility of the engagement?
Well, first of all, the first thing I got to consider is the size of the organization. Materiality in the audit of the financial statements of the city of Nashville, Tennessee, will be a lot higher than the audit of the financial statements of Manchester, Tennessee, which has a population of maybe 30,000 people. Because I could address my materiality level at different levels there.
Right.
How much input do we have for the citizens? Do we have a lot of people attending the meetings? Are they involved on a personal basis with the management and operation of city governments? So I look at the involvement of the citizens. If I know that the citizens will never even see these financial statements, I may not be as concerned about the, quote, materiality level, or lowering my materiality level, because here again I don't have the risk of criticism. But I just want to give the illustration of a point. The literature defines materiality as something that would cause the judgment of a reasonable person to be changed if they are aware of this information. That's the theoretical definition of materiality. I say in the public sector, materiality is determined by public perception. In other words, what does the public perceive the materiality to be? And I use this to illustrate my case. You have a set of financial statements that you're auditing of a governmental entity, and you have 10 accounts. One of them is absolutely risky. It may be some kind of program that there's no internal controls. Risk is at maximum here. And your tolerable error for the entire set of financial statements is $800,000. You start auditing and this particular account has $200,000. That's all that's ever been in it, for discussion purposes. And you start auditing those financial statements. It's going to be a financial statement audit at the least risky accounts first, which is fine because you can gain knowledge about the internal controls of this operation as you're going down. And by the time you get to your 10th account, which is the most risky account, you've only used $400,000 of your tolerable error. So in accordance with the standards, you've got $400,000 left over. This most risky account that you're scared to death what you might find in it if you look in it only has $200,000. So in accordance with the standards, what can you do?
You can audit it.
You can do nothing.
All right. Okay.
Because you got $400,000 in tolerable error left.
Okay.
You got $200,000 in this account. If somebody walked off with every dollar in the account, you'd still be in accordance with the standards. $200,000 under your tolerable error. So you walk away.
But your public perception test.
See, here's where it comes in. All right, so you walk away, issue the financial statements.
Right.
And 2 months later, it finds out that old Billy Bob walked off with all $200,000. And they go to trial. They prosecute him. Mr. Auditor, did you audit these financial statements? Yes. What type of opinion did you issue? Clean opinion. Any recommendations for improvements in internal control? No. Did you know that Billy Bob walked off, or we're trying him for walking off with $200,000? Yes. Were you aware that this was a very risky account in these financial statements? Yes, I did. Were you aware that the possibility of fraud existed in these accounts? Yes, I was. Did you audit that account? No. Well, why not? Oh, that's below my tolerable error. Do you think the members of the jury give a flip about your tolerable error?
No, and I have a feeling the Board of Accountancy might not even.
Well, in accordance with the standards, you can defend what you did.
Yeah, I understand.
In accordance with the standards. But to the public, they're going to have a hard time swallowing the fact that that was below your tolerable error. So here again, we define materiality by public perception.
Because I could think, for instance, and I was thinking of the public perception slightly differently by saying, if there is a major error, let's just say in the prison cost,
Okay.
people might be more forgiving of that because than if the same dollar magnitude or percentage magnitude problem happens in child adoption services.
Well,
just because of the newspaper play of the children versus the hardened inmate kind of thing.
You know, we're not particularly interested in how prisoners are treated. You know, they deserve to be there. They deserve whatever they get, so to speak. But when we have children, you know, we have had a lot of publicity in Tennessee. We've had a couple of children. It's very, very unfortunate situations. The daycare agency collected the children at the homes as they go by, and they left, in 2 instances, they left children in the van. They were infants, and left them in there all day long, and they died because of heat. You know, the public can really get up in arms about those situations because everybody has kids.
Sure.
You know, so those programs where the public has a lot of interest in, you better consider lowering your materiality.
Okay. When you go in and you're looking for fraud, you're really not looking for it, are you? You just sort of, you've planned, you've got your scope such that you may have an awareness of the possibility of it, you've tested the environment. What puts you on alert?
Well, always you should go in with what SAS 82 talks about is professional skepticism. Not that everybody will steal or is stealing, but they could under the right circumstances. So you are to have this professional skepticism SAS 82 talks about from the planning stage to the completion stage, because you could see something at any time during the audit that you didn't plan for because you didn't know was there. So you need to know what the indicators of fraud are, and you need to be aware of them throughout your examination.
You call these red flags.
Yes.
What is a red flag?
Well, a red flag is not necessarily fraud. It's an indicator because of the circumstances. It creates a situation where a person could, because of a lack of internal controls or because of a change in lifestyle or living, it could be an indicator or it could provide an opportunity for someone to commit fraud. And under those circumstances, you need to determine if fraud was committed, could it have a direct and material effect on the financial statements? And if so, you need to determine if indeed it was committed by expanding the scope of your audit or designing testing procedures to determine if indeed fraud has occurred. But let me caution you on one thing. There are no little frauds.
No little frauds?
No little frauds. They're just little ones waiting to grow. Because, see, a fraudster is a tester and a prober. A fraudster will commit a little fraud to begin with. And a colleague of mine in Louisiana made the statement, which I give him credit for, fraud and stupid often look exactly the same. You know, is it a stupid mistake or was it fraud? And there's only one thing that determines if it was a mistake. There's only one difference between a mistake and a fraud, and that's intent. And we as auditors have to sometime determine what was the intent of the individual when they made this, quote, mistake. Well, how many times did you make the mistake? Oh, about 32 times. Well, you know, we make mistakes